Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to this episode of Provident's Healthcare Dealcast. This is Steve Grassa speaking. I'm joined by a colleague of mine, Abe and Boj. Today we're going to discuss COVID-19's impact on M&A activity within the healthcare services space and how deal activity has fared and how it's morphed since the lockdowns took effect in March, when markets essentially tightened up and most processes were either put on hold or delayed. It's been a very trying few months for millions of people and swaths of industries throughout our country, especially in healthcare, which has historically been more resilient to economic downturns, and some other more cyclical industries. Some subsectors were partially insulated, which we'll explore later on, but this episode was quite crippling for most of the healthcare system, much in the same way that it was for a lot of cyclical sectors as well. And anytime there's a disruption to business activity, there's a disruption to M&A as well. So in March, most transactions that were set to close in the coming months were put on hold. A lot of sell-side processes were paused, and M&A markets essentially froze until there'd be more clarity and visibility around a path forward and a path to recover lost volume. There were some deals that were able to get done in the midst of this pandemic, and most of the transactions that were able to get through to the finish line were done so with a good bit of restructuring to help solve for a lot of the added risk and financing issues that emerged as a result of COVID-19. My colleague Abe was intimately involved in a deal that closed shortly after the lockdowns took effect. Abe, do you mind talking through some of the biggest obstacles that you've seen obstruct deals from getting done, lenders, uncertainty, what have you, and how you and some other groups were able to and are able to solve for those issues?
Absolutely. Appreciate the introduction, Steve. COVID was definitely a big impact on the M&A markets. I think initially with the lockdown and quarantine, the first order of impact was, some sort of business deterioration across kind of the healthcare services continuum, very specifically into a lot of provider-based specialties of healthcare services, and then more specifically into kind of the elective segments of provider practice management businesses. So COVID certainly brought a pretty substantial impact to the market, and there were lots of transactions that were due to close, late March, early April, that ultimately needed to be put on hold or had to move forward under very creative structures, which we'll talk about later on the podcast. But initially it really stemmed from business deterioration, right? Volumes took a deep dive across healthcare services, and that really caused a couple things. I think one, from the perspective of buyers in the industry and strategic acquirers and private equity firms, if you're a strategic acquirer, number one, your business was in peril. So a lot of strategic acquirers were forced to have to figure out, the impacts of COVID on their own business before they were able to go out and begin acquiring other businesses. So for transactions that were happening with a strategic, they had to, think about what was going to happen to the underlying business, not only of the seller, but of the buyer as well, and what the timeline for a potential recovery was going to be. I think also those businesses needed to conserve a lot of liquidity, meaning that they had to hold, more cash on their balance sheets than they normally might otherwise, which was important, and obviously makes it difficult for a strategic to finance a transaction with cash on hand. Another aspect of the market was that the lending environment became very tight. So it became very difficult for private equity firms to finance new transactions, specifically platform transactions, using the same level, if any, of third-party debt that they had previously used, which makes it difficult to complete transactions. So that's really led to a couple of things. Number one, every market around the country is coming back to life at sort of a different rate. But this has really led to a couple of different structures that have been really propagated in order to try to get transactions closed at the previous terms, previous valuation, but albeit there needs to be some creative structuring in order for the buyers to be able to have enough comfort and ability, frankly, to move forward and come up with the financing necessary. The first most common we've seen are all equity transactions where, a private equity firm will just put up all of the cash out of their investment fund to fund the transaction. And this obviously eliminates the need for getting third-party financing. This is typically probably the least common of all the structures we'll talk about, just because, putting up all the cash from your investment fund is not always the most efficient way to finance an investment, and typically they don't like to use that option. And also, if you're going to put up all cash in equity, typically there may come some discussions around what the valuation of the business should be, just because having third-party financing enables private equity firms to pay higher prices. So when the third-party financing goes away and they have to put up all of the equity in the form of a cash check, sometimes valuation can come down. The second type we've seen are seller finance transactions, whereby the seller will defer a portion of the purchase price, and that portion of the purchase price will be treated as a debt-like item on the balance sheet. And the intent is that when the market returns back to normal, the business will refinance that debt out, and that will be paid back to the sellers. And then the last structure we've seen this is the most creative item, I would think, but really deferred transaction structures. So this is where we've seen a number of transactions, and this is probably the most common option of all three, where there's a deferred payment structure in place that's usually tied towards some sort of productivity metrics of the practice returning back to, call it, pre-COVID levels of productivity. So all these structures are intended to hopefully allow the deals that have been, in process for a better part of 9 months to a year, under terms that were negotiated pre-COVID, to be able to move forward at the same valuation that was negotiated pre-COVID, albeit some creative structuring. And usually if the businesses are able to perform at pre-COVID levels, they'll receive all the cash like they would have pre-COVID.
Yeah, and I think to your point on financing, I think that strategic buyers with revolving lines of credit and such probably have better access to the capital markets, and ultimately to financing in this type of environment. And so maybe a little bit more active than private equity firms. You also need to consider the nature of costs post-closing. So with the private equity model, it's one wherein they'll invest heavily into the infrastructure of a business so that it can grow and scale, while strategics, on the other hand, will likely have already built out corporate infrastructure and will likely realize synergies from a deal that could end up cutting costs as opposed to adding to them post-transaction. So naturally, it makes sense that strategic deals have gotten done more than new platforms that may have formed. But that's an excellent encapsulation, Abe, of what we've seen play out. And I think now we've reached an inflection point where initially we immediately jumped to a freeze, wait and see period as we brace for the uncertainty that came with the initial shock of the pandemic. And again, at that point in time, there was no real timetable for return or what, return to normalcy would ultimately look like. Now it seems we've entered a new, warmer, wait and see phase. It's not wait and see when things reopen again. It's now a wait and see the shape of the business recovery and what the return to steady state looks like. And that involves a lot of KPI analysis and tracking. So as states have opened up and companies have started to come back online and ramp to capture a lot of the pent up demand for services, the buyer universe is tracking very closely and starting to gain comfort around the progress so far. May for most states was a gradual ramp month, and now June and July will be key indicators to provide visibility around how groups are able to recover. So we've certainly seen buyers more engaged although still cautious around the risk of a potential second surge. But, barring any steep setbacks, we think that this massive backlog of deals and pent-up demand will lead to very high transaction volume in Q3 and Q4 of 2020. And, Abe, the question remains then, what will these deals look like in terms of structuring and in terms of valuation, especially for companies that are kicking off new processes? Do we see an environment of softened valuations, holdback structures like you had mentioned at the onset of the conversation? What are you hearing, and what are your thoughts on how deals will look going forward?
Yeah, it's a great question. I think for companies that are coming to market now, one of the things we're obviously spending a lot of time doing with our clients are looking at, what are the normalized trends of the business post-COVID, right? So you have to take the couple months that we just went through and figure out what a normalized level of business is. And this is for businesses that have recovered. There's plenty out there that are still on the path to recovery. But on a market-by-market basis, there are certain pockets around the country where volumes have come back almost 100%, which has really created kind of an interesting situation where you have sellers' businesses that are smaller businesses, less diversified. So they're more exposed to a particular market, call it maybe oftentimes in the Southeast or a lot of companies in Texas have come back to their pre-COVID levels or are very close to them, but they're pursuing transactions with, large national businesses that have maybe are in markets around the country. And you're kind of presented with a unique situation here in that the sellers' businesses have fully recovered, but buyers in some instances are waiting are seeing recoveries themselves, but they're in some cases restricted by their ability to finance transactions through a third-party lender. So it still kind of will impact the structure and valuation of these transactions for, probably 6 months to a year, as lenders are still going to hold tight on financing large transactions for even strategic acquirers with cash that they have on their lines of credit or available financing facilities until the lenders also have comfort on, returns and sustained volumes. Because it's one thing to get back to 100% in short order, but it's another thing to sustain that. And it's anybody's guess, frankly, whether there's going to be a second wave or anything like that. So lenders definitely want to see sustained normalization, which has led to, again, kind of what we had talked about, several transaction structures, all equity transactions, seller financed and deferred transaction structures are certainly becoming more common in the proposals that we're seeing within the market. I think as well, the buyers are receptive to COVID normalizations on the earnings. If you're looking at a business that has the COVID period in the trailing 12-month financial period that the transaction is based on, we haven't seen valuations. I think a lot of people, myself included, were expecting valuations to come down at least a little bit as a result of kind of COVID. I think it's probably actually too early for us to have seen the impact on valuations, right? Sellers just didn't decide overnight that all of a sudden they were going to sell their businesses for 2 or 3 turns of a multiple lower than they might have otherwise previously. So I think seller expectations are still fairly high. Buyers are willing to get there, albeit there's got to be some creative structure put in place that you've just got to hit the targets that the business was generating pre-COVID, and assuming that a structure can be put in place over the next 18 to 24 months or 12 months that allows the business to return to normalcy and prove that it's going to be sustainable, then buyers are willing to have pre-COVID valuation levels. I think the next step will be businesses that perhaps don't all the way recover. There's certain types of businesses where perhaps they don't reach back to 100% of their pre-COVID levels, and that will obviously have an impact on the business going forward.
Yeah, and I would just add that the multiple, which is used as a proxy for valuation, is ultimately a function of the riskiness and the growth trajectory of the cash flows of the business. And we're in a situation where, depending on the sector, the risk and growth profile have certainly shifted. The question is it enough to offset a lot of the tailwinds that have driven valuations higher the last few years? There's an enormous amount of liquidity in the system. So private equity firms have trillions of dollars of dry powder to deploy and invest in businesses to generate a return for their investors. And that money needs to go to work. Also, much like the real estate market, because deals involve third-party debt financing, prices go higher when debt is cheap and when rates are low, which is obviously the case at this point in time. And thirdly and lastly, healthcare, although not insulated from this pandemic, is pretty resilient to economic downturns that could ultimately impact disposable incomes, especially in areas that are more essential than elective. We think there will continue to be a lot of demand for those sorts of businesses, which actually brings me to my next thought on sectors that could potentially benefit from this type of ordeal or this type of episode. I think that a few factors will ultimately determine that. The nature of services being one, essential procedures will likely fare better than more elective ones, although hopefully providers are able to capture a lot of the pent-up demand for elective services as well. Manner of care delivery is another, so remote or home-based care may benefit relative to larger clinics or hospital systems, say. Patient demographics, so obviously the geriatric population is more vulnerable and at risk. And then mode of payment could be another. Depending on the economic impact of the pandemic, cash pay procedures may take a hit relative to reimbursable ones as well. So these are all factors to consider. And one space that comes to mind immediately for me is healthcare IT and specifically telemedicine. It seems that COVID has accelerated a lot of trends that were starting to gain traction and really rolled up the next 5 to 10 years and condensed it to the next 1 to 2 years. Telemedicine, goes without saying, is going to be a very hot space, especially within mental health and telepsychiatry subsegments, which were already gaining some traction. There's a handful of platforms already in the telepsych space today. Mental health as a standalone platform was experiencing quite a bit of consolidation activity and demand before this added pandemic-induced stress and anxiety. And when you pair it with a space like telemedicine or technology like telemedicine, it adds even more oxygen to the flame. So there are plenty of spaces that are positioned to benefit from the pandemic as well. Abe, any particular areas that you're tracking where you'd expect to see a pickup in demand or deal activity?
Yeah, I think what's been interesting in the PPM space has been the differences amongst the specialties in medicine based on how elective the procedures are. So, you take a segment like dental or GI, those procedures are pretty highly elective, right? You can wait to have your colonoscopy, especially a screening colonoscopy, and you can wait to go see your dentist for your regular checkup. So people have deferred those types of appointments. I do think there will be some pent-up demand certainly later on, but in the short term, a lot of that was deferred. But segments like pain management actually proved to be fairly resilient during COVID. They were actually designated as an essential provider of care. Patients need to deal with their pain on a regular basis. So, we've actually seen the volumes in that industry. They took a hit just like every other space, but some industries like GI and dental, they were down to 20% of their volume in their surgery centers or 30%. I think, for pain management, we've heard groups quoting that they were down to 60, 70% of volumes, which considering all that was going on, that's really good. And they've been able to restore that volume pretty easily. And in a lot of cases, they're operating at over 100% of their pre-COVID volume because of the pent-up demand. So for some of these groups, they've been able to weather the storm pretty well. And that's actually led to private equity firms proactively reaching out about the opportunities within pain management and others wanting to understand the space. Because it is, especially as you move forward into an environment in the future where this type of risk is out there in the world. You said it really well earlier, right? The multiples are a function of perceived risk and growth opportunities in the future. And frankly, when evaluating healthcare services businesses, prior to COVID, no one expected a pandemic to play into their valuations. And for some of these businesses that were so deeply impacted by this, it will linger in the minds of private equity firms and strategic acquirers. So if there is instances within certain segments like pain or healthcare IT and telemedicine where buyers can have comfort that through some sort of pandemic or event like this, that there will be an ability to maintain cash flow and profitability and continue to operate the businesses, that'll certainly give them more comfort and bidding strong valuations.
Yeah, I agree. And I think, just as there will be winners and losers within particular subsegments of healthcare, I think we're expecting that same narrative to play out within certain markets. And I think that a lot of private equity-backed groups will fare better than others, and a lot of independent groups will fare much better than other independent groups as well. We could definitely see a situation where a lot of the smaller players, as you alluded to earlier on in the conversation, their appetite for a sale may be more pronounced right now, just given that it provides them an opportunity to monetize their equity, diversify risk away from the business, but it also gives them the ability to offload a lot of the administrative and operational burden to whoever they choose as their partner, who, by the way, is likely backed by private equity dollars with plenty of capital, infrastructure, and resources to better weather the storm than, say, a sole practitioner or a smaller provider likely could. And I think the same holds true for private equity-backed platforms as well. Some groups in hard-hit areas and markets may struggle more than others, and some groups may be over-levered, which means that for business owners contemplating a sale, it's more critical now more than ever to do your reverse diligence, to ask the right questions, and even interview other providers or shareholders within each parent company's umbrella, just to get a better sense for the support that was provided by the platform during this event and how they were able to ultimately respond to this episode. So with that, thank you everyone for joining us and listening in. We're happy to answer any questions that come up as you continue to try and navigate through these uncertain times. I encourage you to visit our website, which hosts a lot of proprietary content and resources that we put together on a number of topics relating specifically to healthcare and to M&A. So thank you all again, and hope you enjoyed.